Hello everyone. In continuation with the last video, we are discussing about a concept called as accounting policies. So welcome. In this video, we will be understanding what is accounting policies, what are the major two types of accounting policies, and what are the different types of accounting policies adopted by businesses across the globe. Basically, we need to understand what is a meaning of policy. Policy refers to any written guidelines, documents that a company adopts for the purpose of financial reporting process. So this will actually set out a specific rules and auditing standards for measuring financial condition. The policies may be classified as conservative or aggressive. Actually, it depends upon what approach they are going to do a financial reporting. For example, if we are choosing conservative policy, that means companies may require entities to adopt more cautious kind of an approach. Okay. Now, there are other factors to consider when classifying the accounting policies. For example, some businesses may follow international financial reporting standards, that is called as IFRS, and other companies may adhere to the generally accepted accounting principles, which we called it as GAAP. So there are other prominent accounting policies which international businesses often will follow. But actually, based on the factors we are considering, classifying the accounting policies into two major types. And what are these two major types of accounting policies? The first one is International Financial Reporting Standards, IFRS. IFRS is basically a global standard for financial reporting. The other one is called Generally Accepted Accounting Principles, usually called as GAAP. GAAP is a standard in United State. See, IFRS is also a set of global standards that businesses must follow in order to prepare their financial statements. This was developed by a authoritative policy board called as International Accounting Standards Board. So IFRS are more principle based than GAAP. This means that there is more room for interpretation when they are following these guidelines. IFRS also allows the companies to use estimation techniques in order to find out any figures. But this is not adaptable or it is not allowed in GAAP. Whereas IFRS is less prescriptive than GAAP. This means that the businesses have more freedom in how they have to report their financial information. In case of GAAP, GAAP is basically a standard accounting framework which was followed in the operations of United States. It was created by Financial Accounting Standards Board, FASB. Actually, as IFRS, we told IFRS is principle based, GAAP is more rule based. This means that there is less room for interpretation when we are following the guidelines. GAAP will prohibit the companies using estimation techniques to calculate any kind of figures. This is allowed under IFRS. GAAP is more prescriptive than IFRS. This means that businesses will have less freedom in order to report their financial information. These are the two major accounting policies that we come across. Now, what are the variety of accounting policies that businesses may adopt? The first policy is called revenue recognition policy. This is actually recognizing the revenues in the financial statement. The time when the revenues were recognized, what time the income was generated, what is the a period of that particular firm's income was there. If you were using accrual basis, revenues are recognized only when it is occurred in the reporting period. If you're utilizing any of the software, it will be very easy for us to recognize. If you're doing it in a cash basis, your company will record it only when the cash is actually received. So this type of policy is called revenue recognition policy. The second method is called cost principle. So this principle will state that any assets should be recorded at the amount paid to acquire them. So depreciation will be always recorded separately. This policy is also called as historical cost principle method, where the assets are recorded at the amount that we are actually paying to acquire them. Third policy is called as matching principle. In this case, that it states expenses should be matched with the revenues that they are held to be generated. Cost and revenue should be recognized on any sales during the period of time. This is called matching principle. Revenues should match the expenses actually made. The fourth method is called full disclosure principle, where all the information, relevant information in the financial statements is being disclosed. This includes both positive and negative information, but in order to protect the interest of investors and in order to make sure that the stakeholders are benefited, we are going to publish all the information relevant to the organization. So this method is called full disclosure principle. The last principle is called as principle of objectivity. So this principle in the financial statements will be prepared with object and without bias. That means there is no partiality. And also, no personal opinions and judgments are included in order to create or in order to do a financial reporting. Basically, these are the generally different types of accounting policies that the businesses may adopt.